Hey guys, I'm Pav, lead market analyst here at Swyftx, and we're back again this week with another edition of The Squawk, which is our weekly insights to give a bit of a take on what's happening in the market, as well as what to look forward to. Now, this weekend was a pretty interesting one. I usually don't get too many people in my personal friendship circles ask me much about the crypto markets, but I thought weirdly enough, maybe, I guess with oil going crazy and the Middle East really just not really seeming to settle down, I did have people just asking me, how's crypto markets going for once? And I was thrown back a little bit surprised because I would have assumed they all know the answer. It's been down a little bit in recent times, but I wanted to take this week's episode to really take some time to maybe articulate some of the broader ways that I'm thinking about the markets moving forward as we start a new quarter, a new month. I'll explain why that's really important when we look at the market structure as a whole. Just because when I spoke to my friends, obviously I kept it quite high level, pretty diplomatic, but I think you guys tuning in every week for this sort of content, I think it's really important just to go through maybe some of the more ideas and frameworks, how I'm thinking about the macro environment and some of the technicals out there, just to form some sort of thesis and share with you some of the upside and downside potentials in the market. Now, I'll start this off by obviously acknowledging that these aren't just ideas, they're just frameworks or ways to think. They're not prescriptive advice on what you should do with your portfolio. So just keep that in mind that you really need to pick for yourself what works best for you. Now, obviously, just to start up with the market, the last 7 days, we have seen things soften a little bit. And one of the key drivers when we look at things like market structure is some other parts of the crypto market, which I'm going to touch on specifically, is the options market. Now, we saw $14 billion worth of options expired in the last few days as we headed into the end of the quarter. Now, that's important. Now, fundamentally, why that's important is because if a market has a whole bunch of options, they're betting on if the market's going to go up or down. Options, they tend to be a little bit different to other derivative products in the sense that they can provide downside protection. Again, all you need to know here is that if someone is protecting their portfolio to the downside, the venue or the exchange at which they're opening that position, that party has to take the opposite view. So again, what happens is as we approach these key expiration dates and exchanges have large amounts of notional volume that are coming up for expiry, a good example right now, we obviously have passed that wall that I just spoke about of $14 billion, but we have this wall between the 24th and the 26th. This is looking at Deribit data on CoinGlass. We have about $14.7 billion when we add all these bits up here, expiring in that window of time. So what you tend to find is because there is so much open interest in that period of time, as we approach 4 to 5 days away from these expiry timelines, a lot of these dealer brokers, they have to start hedging these positions. So again, if the whole market's betting on the downside and they're betting for upside, they have to try and balance that market, which gets more and more volatile as the expiration date comes closer. So all that really means is as we have it headed into the end of this quarter, you may have noticed when you looked at some of the charts out there that things did look very volatile, very choppy. And this can be one of the contributing factors as to why the market becomes choppy during the end of a month and a quarter, because it's a very unique period where we get those monthly contracts expire as well as the quarterly contracts expire. That convergence is what is potentially adding to the volatility. Now, what happens is when they step off having to manage the upside and the downside of their books, we can start to see a trend form. And that's the key thing that I want to call out with this episode with what I'm going to talk about from an economic backdrop is that now that we've had maybe some of the headwinds, you could call them, or tailwinds, however you want to look at it, within the market that's been maybe governing the way that prices have been moving for the last few days. It's not manipulation. It's literally just a market maker doing the job that they need to do. We might start to see an environment where trends may form and continue to run as opposed to what we've seen, which is essentially just a ping pong, almost like grid-like action in the market. And what I think is maybe the way that we potentially get a steer there, one way is obviously with what we're seeing geopolitically at the moment. I'm not going to dive into that too much, but essentially if we do see any sort of inflammation of the whole situation over in the Middle East, that's a potential source or catalyst for driving market sentiment. Another one, which I've been tracking quite closely on the Squawks, has also been the jobs market. Now, again, just to reiterate things that we've spoken about in previous episodes, when we talk about economic policy, that tends to be the easing or the tightening of financial conditions, and that hits risk markets. So we are in a period of time where if we look at what policymakers are in charge of, it's growth, it's jobs, particularly in the US, not every country, but in the US, the largest consumer base in the world. It's all about understanding if they're the largest consumer base, we're in a market where people are either risk on or risk off. How are consumers feeling, broadly speaking, about how they're going in regard to then being able to look into things like crypto as ways to express risk in the market? So Where this is going is we have tomorrow, which is Friday at 10:30 p.m., the monthly month-on-month employment rate change, as well as the unemployment rate coming out. So this is pretty crucial because I want to just jump to this chart here. Now, this is important because if jobs are slowly trending down, it's becoming harder to see employment being plentiful in an economy. You can start to see growth go down. And as growth goes down, people have less money to spend. And you can see where I'm going with this. It has a knock-on effect on the way that people express their risk in markets like crypto, right? If people don't have the money to put into crypto, they simply won't. So we can see since 2022, there's been a gradual decline in the amount of new jobs being created to the point where we've actually had negative monthly readings. And the most recent one is pretty important because the expectation was, if I just open this up here, the expectation was for right here for 58,000 jobs to be created, and the actual result was negative 95,000 jobs. So again, when we're seeing misses like that, it's really quite confronting potentially for the market, particularly if it becomes a trend. If it's just an isolation, it's not too big of a problem. But when it becomes a trend, like a consistent down, if we see consistent negative figures, that's when we may see some pressures form further in that employment market. And at the same time, we've seen since 2023, unemployment rate rising. So again, these are long trends that we're seeing play out. But when you're a policymaker and there are pressures to keep both growth running as well as jobs intact, but not overshoot inflation, this is where things get pretty sticky. And it's quite important to just watch what's happening in the broader market, because while we might see sell-offs potentially in the market, like we did most recently, we saw a 3% sell-off from total market cap when we saw this when this jobs miss came in last month. While the short-term reaction might be a sell-off, it sets that expectation that at a certain point, they won't let it fall any further. A pivot in policy, like we did see the most recent time, which was during the COVID crisis era. So again, not to point that this is heading to a COVID style event, but when there's enough pressure on the jobs market and the economic policymakers are responsible for keeping jobs intact, that's when you start to see this idea of, okay, maybe in the longer run, we could see relief coming, but in the short term, there might be some pain ahead. That's the idea there. And just to really hit home that fact, all you need to know about this chart is, as I spoke about, consumers are important. Well, they're basically making up 68% of the current share of gross domestic product in the US, so GDP. So that's the level of productivity and growth that the whole economy is seeing. So if the consumers aren't doing any better, then it's potentially going to have a larger impact on gross domestic product. Now, there's other input factors that go into GDP, but this is a very key driver is what I'm trying to hit home right now. Now, we've talked about some of the influences in the market. We've talked about some of the economic backdrop and how that's looking heading forward. Now, I want to just explain where the market's sitting technically. I've mapped out on this chart just some of the key data points in terms of monthly, quarterly, and yearly levels. These can vary exchange to exchange, but they're relatively close to each other. Now, what we've seen if we overlay an indicator like the Bollinger Band, which essentially helps us understand when the market is operating at local extremes, we can see when the market has come down these last 3 or 4 times, it has rebounded. But the concerning side also is as we've approached the upside of this range, we've also seen the market fall away too. So essentially what that's meaning is that we are seeing, as much as we might see sellers disappear down here, we're also not seeing the conviction from those buyers to see price go higher. We're just seeing essentially sellers come in, and these are higher highs that have formed so far. Because that's what the market is at the end of the day. It's a matching of buyers and sellers. And when one is in more excess than the other, we tend to see a price drive with a little bit more direction. Now, what's most notable, obviously, most recent days, we have come down back to this range extreme low here. What's going to be the drive or draw on the way price moves from here? The idea for upside is that if we do see the market find a consensus that this is a good place to potentially be buying in the market, I would be potentially looking at anywhere from obviously the other side of it or extreme of this band, and even some of these potential higher time frame price targets, which have some significance. They were basically opens or at least midpoints for key higher time frame candles. At the same time, we can't see any consensus to move higher here, and the market gets really obviously happier to sell more so than buy as we reach through this decision point in the market potentially. It opens up the side for more downside. So there's nothing really stopping this. Maybe doing what it has done for the last few times, just continue to test these range extreme lows. This is a 2 standard deviation of the last 20 candles for those that are interested. But it also opens up the idea that, okay, maybe we see the previous quarterly low get taken out too. You have to play into the lower of the downside here as well. All in all, it sort of gives a bit of a framework on how to think about the market, both for upside and downside. what that could look like in the short term and in the long term as we start this new quarter off fresh. And hope you found it helpful. Always keen to hear what you guys are thinking as well, so feel free to comment. We'll be back again next week. See if we've got any more information to give us an idea of where the market could be heading next. But for now, definitely at that early stage of just understanding what the market wants to do to start off this quarter. Thanks, guys. Catch you next time.